Hello investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Zoom Video. So Zoom Video just reported their Q3 results last night, Q3 22, so their fiscal year is misaligned with the calendar year, so I'll be talking about the fiscal year. And there was a lot of interesting dynamics at place, but meaningfully, it's just the question of how will its growth rate stabilize going into next year's, into fiscal 23. So we got a guidance, we got a raised guidance for Q4 2022, but yeah, let's just unpick this and talk about its valuation and really think about what investors have to look forward to. So, I mean, this stock has just been selling off since like early October of last year. So since October last year, the stock is down approximately 60%. This graph here is only from year to date, but from October, the highs that it set last year, the stock is down 60%. So, you know, everyone was kind of like a buy and hold investor, and everyone is a buy and hold as long as the share price is going up. And one of the things that we saw for investors that came into the market in 2020 was everyone was wanted to buy leaders irrespective of their valuation, and we've seen in the last several days, particularly on Monday, as how Asana was down 20%. Many stocks just totally got utterly demolished on Monday's trade, and it's quite interesting to see because we're now in a kind of a moment where investors are kind of pushing back and the valuations are starting to matter. This is very exciting to me because I've spent a lot of time thinking about this kind of stuff. So here's the thing, they raised their guidance, top line is supposed to grow into next year, fiscal into Q4 2022 by 19% year over year. So there's a very steady decline over time from where it was in Q1 of this year, and then it's kind of phasing out. So the question is, what will the growth rates be like as we go into next year? Now, let me just say a little thing. So Peloton and Roku had, or kind of their share prices had maintained a certain portion of their gains, and it's only really recently that those stocks kind of got demolished. But in the case of Zoom, everyone was kind of very much expecting that anyone that wanted to get involved with Zoom would have already subscribed to Zoom, and so they wouldn't have difficulty. This was not new news, and that's why the stock had already sold out over the last year by approximately 60%. Now, I just want to unpick some things here. So one of the things that I think I want to unpick is that the free cash flow that this business makes. So this business doesn't have a lot of capex, and what they make is a lot of free cash flow, and that's been part of the bullish case, right? And you can see here for Q3 2021, their fiscal, for the quarter ended October 2021, which is their fiscal Q3 2022. This is a bit confusing. So the quarter just reported, they had non-GAAP net income of 39 million. So 339 million, and the free cash flow is meaningfully above that. And the reason for that is that they get a lot of deferred revenue upfront. That is cash that the subscriber pays for the annual subscription upfront. Okay, so it's a very compelling business model. You get money upfront, you just give the service over time. That's typical SaaS business, very, very attractive. But the problem is you need to replace some of that churn, and you need to keep that coming in to get the free cash flow to remain high. And you can see that year over year, last year's October quarter was 411 million, and this year, even though the top line had grown, the cash flow from operating activities was slightly lower. You can see the green and the orange squares there. Now, remaining performance obligations. This is really cash that the business gets upfront for revenues that will be recognized over a multi-year period, and you can see that this is phasing out. So Q3 21, the fiscal Q3 21 was 215% year-over-year growth rate in the RPO, remaining performance obligations, and this is kind of not in a straight line, but it's kind of like just slowly kind of come down. And you can see predominantly that since Q1 of 2022, this last several quarters, it's kind of really come down from 94% year-over-year growth to just 51% year-over-year growth. So this is what I'm trying to allude to. If you're getting fewer and fewer customers coming up, you're going to have less money up front, you're going to have less cash flows, okay? And you can see here, customers with more than 10 employees, you can see that the growth in customer acquisition has come down significantly, and it was only up 18% year over year for this most recent quarter. And so this is what I started the video with. I said that in other words, it seems that everyone that wanted to be on Zoom is already on Zoom. So it's going to be a difficult case here for investors. And you might push back and say, oh, you know, Michael, what difference does it all make? As long as the EPS numbers, the earnings per share, are climbing over time, what difference do I care? And the thing is that operating leverage cuts both ways, right? So you can see here that the EPS numbers for Q3 21, the quarter just reported, was $1.11, okay, $1.11, and that their guidance for next quarter is for $1.07 at the high end. Now, even though the business is up, revenues are up 35% year over year, the EPS number from Q3 of this year, from Q3 of last year to Q3 of this year, was only up 12%. So 35% on top end and at the top line, and the bottom line was only up 12%. And looking out to Q4, we are expecting that it's going to be down, the EPS number, even if it comes in on 107, it'll be down relative to last year's where it was $1.22. So even though they're growing on the top line, it's not really translating into strong EPS growth because, you know, they're investing for growth, etc. But it's difficult to move the needle at this point, and this is what it brings to, right? So let's say, you know, analysts following the stock expect that Zoom will grow its top line by 18% into next year. But let's just say, okay, that's low, the guidance, let's say they come in at 20%, or even somewhere between 20 and 25%. Are investors really going to be paying 15 times forward sales for a business where the best of its growth days are in the rearview mirror? And I find that difficult because, I mean, it's just the market has pushed back so much on these growth stocks that there's loads of these growth stocks now that are growing meaningfully faster than 30% CAGR and priced in single digits, so forward sales. So why would you pay 15 times forward sales for Zoom at growing probably at 20% when you can get loads of other names that are growing meaningfully faster in the single digits? I mean, it doesn't really make sense. One retort to that could be, okay, yeah, you know, Zoom is an incredibly profitable business. It makes a lot of free cash flow. You know, it has a lot of debt. Has a lot of cash on its balance sheet, more than $5 billion. So they can continue investing very aggressively. Yes, I hear all those arguments, but I don't know, man. I just find it difficult to kind of get myself convinced to pay for 15 times forward sales for this. But anyway, if you want to find out what kind of stocks I'm interested in, don't forget to check out my marketplace. It's called Deep Value Returns. I help you become a better investor. And you can check out what other people said in my reviews to see, you start your due diligence there. Okay, thank you so much for listening.